Adjusting entries. This segment's learning objectives are to explain the purpose of adjusting entries and describe and prepare the four basic types of adjusting entries. The purpose of adjusting entries is to allocate revenue and expenses among accounting periods in accordance with the realization and matching principles. These end-of-period entries are necessary because revenue may be earned and expenses may be incurred in periods other than the period in which related cash flows are recorded. The four basic types of adjusting entries are made to convert assets to expenses, convert liabilities to revenue, accrue unpaid expenses, and accrue uncollected revenue. Often a transaction affects the revenue or expenses of two or more accounting periods. The related cash inflow or outflow does not always coincide with the period in which these revenue or expense items are recorded. Thus, the need for adjusting entries results from timing differences between the receipt or disbursement of cash and the recording of revenue or expenses. For purposes of measuring income and preparing financial statements, the life of a business is divided into a series of accounting periods. This practice enables decision-makers to compare the financial statements of successive periods and to identify significant trends. But measuring net income for a relatively short accounting period, such as a month or even a year, poses a problem because, as mentioned previously, some business activities affect the revenue and expenses of multiple accounting periods. Therefore, adjusting entries are needed at the end of each accounting period to make certain that appropriate amounts of revenue and expense are reported in the company's income statement. For example, magazine publishers often sell 2- or 3-year subscriptions to their publications. At the end of each accounting period, these publishers make adjusting entries recognizing the portion of their advance receipts that have been earned during the current period. Most companies also purchase insurance policies that benefit more than one period. Therefore, an adjusting entry is needed to make certain that an appropriate portion of each policy's total cost is reported in the income statement as insurance expense for the period. In short, adjusting entries are needed whenever transactions affect the revenue or expenses of more than one accounting period. These entries assign revenues to the period in which they are earned, and expenses to the periods in which related goods or services are used. In theory, a business could make adjusting entries daily. But as a practical matter, these entries are made only at the end of each accounting period. For most companies, adjusting entries are made monthly. Most adjusting entries fall into one of four general categories: converting assets to expenses, converting liabilities to revenue, accruing unpaid expenses, accruing uncollected revenue. A cash expenditure or cost that will benefit more than one accounting period usually is recorded by debiting an asset account. For example, supplies and unexpired insurance, and by crediting cash. The asset account created represents the deferral or the postponement of an expense. In each future period that benefits from the use of this asset, an adjusting entry is made to allocate a portion of the asset's cost from the balance sheet to the income statement as an expense. This adjusting entry is recorded by debiting the appropriate expense account. For example, supplies expense or insurance expense, and crediting the related asset account. For example, supplies or unexpired insurance. A business may collect cash in advance for services to be rendered in future accounting periods. Transactions of this nature are usually recorded by debiting cash and by crediting a liability account, typically called unearned revenue or customer deposits. Here, the liability account created represents the deferral or the postponement of a revenue. In the period that services are rendered or the goods are sold, an adjusting entry is made to allocate a portion of the liability from the balance sheet to the income statement to recognize the revenue earned during the period. The adjusting entry is recorded by debiting the liability, unearned revenue or customer deposits, and by crediting revenue earned, or a similar account, for the value of the services. An expense may be incurred in the current accounting period even though no cash payment will occur until a future period. These accrued expenses are recorded by an adjusting entry made at the end of each accounting period. The adjusting entry is recorded by debiting the appropriate expense account, for example, interest expense or salary expense, and by crediting the related liability, for example, interest payable or salaries payable. Revenue may be earned or accrued during the current period even though the collection of cash will not occur until a future period. Unrecorded earned revenue for which no cash has been received requires an adjusting entry at the end of the accounting period. The adjusting entry is recorded by debiting the appropriate asset, for example, accounts receivable or interest receivable, and by crediting the appropriate revenue account, for example, service revenue earned or interest earned. In an accrual counting system, there are often timing differences between cash flows and the recognition of expenses or revenue. A company can pay cash in advance of incurring certain expenses or receive cash before revenue has been earned. Likewise, it can incur certain expenses before paying any cash or it can earn revenue before any cash is received. These timing differences and the adjusting entries that result from them are summarized as follows. Adjusting entries to convert assets to expenses result from cash being paid prior to an expense being incurred. Adjusting entries to convert liabilities to revenue result from cash being received prior to revenue being earned. Adjusting entries to accrue unpaid expenses result from expenses being incurred before cash is paid. Adjusting entries to accrue uncollected revenue result from revenue being earned before cash is received. At the end of the period, we need to make adjusting entries to get the accounts up to date for the financial statements. The accrual basis dictates that revenues be recognized when earned and expenses be recognized when incurred. The accrual basis of accounting follows Generally Accepted Accounting Principles, or GAAP. Every adjusting entry involves a revenue or expense and an asset or liability.